UPS stock is one of the most talked about dividend stocks on the market right now, and we can see it's sold off by a large amount in the last year, down about 28%, and they now have a starting dividend yield sitting right at 7%. So this is a high yielding stock. And keep in mind, if we look at the dividend growth rates for this company, it's actually quite attractive. The data will load in thanks to ticker data, and we can see they have a 5-year dividend CAGR of above 10% and a 10-year of around 8.5%. So when you combine a 7% yield and a 5-year dividend CAGR of around 10%, that sounds like extremely attractive dividend metrics. But if we take a deeper dive under the hood, I have some serious concerns about the dividend sustainability for UPS. So in this video, we're going to be analyzing the dividend and also seeing if we can calculate the fair value to decide if this is a major buying opportunity. But first, I want to mention that Ticker Data is currently running its Black Friday sale, where you can get 30% off the yearly plans by using code BLACK at checkout. Ticker Data is a spreadsheet integration tool that allows you to automatically import stock financials directly into your spreadsheet. And when you get a Ticker Data premium plan, you get access to all these pre-made templates that you've seen in probably all of my videos. And it's also the tool that I use to track my portfolio. If you look at the docs page on tickerdata.com, you can see we have income statement metrics, statement of cash flow metrics, balance sheet data, and then a plethora of key metrics that allow you to dive very deep into the company. And one of the things that makes Ticker Data quite unique is it has access to over 70 different exchanges all across the world. So essentially, almost no matter where you live, you can pull in stock data from that country. This is a very international friendly tool. There's a 7-day free trial, and again, use code BLACK to get 30% off the annual plans. Now, UPS recently released their latest quarter's earnings reports where they actually announced beats on top and bottom line. So this was a pleasant surprise for UPS shareholders, but this recent earnings report still left some concerns. So let's talk about it for a moment. But before we look at it, take a closer look at the dividend metrics that we just looked at. Yes, the yield looks high, it's attractive. The dividend growth, historically speaking, has been quite good. But one of the things we have to remember about dividend growth is only sustainable if it's backed by growing free cash flow. So let's take a deeper dive into what's actually been going on. To start, we can see from 2021 to 2022, there was a massive dividend increase of basically 50%. That's a huge dividend hike, and it was followed the next year by a relatively large dividend hike once again. But then the next year, it was a very, very small dividend increase. Now, we can see from 2021 to 2022, if we look at the free cash flow versus dividends paid out, 2020 to 2021 saw a huge increase in free cash flow, which is likely why the company felt somewhat comfortable increasing the dividend by such a large amount. But look at what's happened since then. Free cash flow has been declining. It's declined a lot. 2023 was about $5 billion, so it was basically half of what it was in 2021, and then in 2024, a slight bump up to $6.2 billion, but still nowhere near those previous 2022 and 2021 levels. So free cash flow has been declining, while the amount paid out in dividends has significantly increased. In 2021, they paid out about $3.4 billion, but in 2024, $5.4 billion. So what happens when free cash flow is declining and dividends are increasing? Well, the free cash flow payout ratio increases. It increases substantially. The free cash flow payout ratio went from 31.8% all the way up to above 100% in 2023 and about 87% in 2024. So what happened with those dividend hikes? Well, in reality, those dividend hikes are what we would call unsustainable dividend growth. It wasn't backed by growing free cash flow, and this has led the free cash flow payout ratio to go quite high. Now, the most recent data we have is for 2024. The company hasn't reported full 2025 data yet, but where are they currently sitting? What do the dividend metrics year to date currently look like? Well, we can find out by taking a dive into their earnings call. If we slide down to page 19 in the earnings call, we can see their year-to-date cash flow and their capital allocation. Now, capital allocation is the most important job of management, and I'm always amazed to see how little other investors or analysts talk about capital allocation because it's simple math. It tells you what the company's prioritizing, and it tells you what's sustainable and what's not sustainable. Now, we have to remember, the 5 options management has is to 1, reinvest back into the business, 2, they can pay down debt, 3, do mergers and acquisitions, or 4, buy back shares, 5, pay out dividends. A company cannot sustainably pay out more in dividends than they generate in free cash flow, and the same is true for all those other categories as well. So we can see year to date in 2025, the company has generated $2.7 billion in free cash flow. but they've paid out over $4 billion in dividends and already completed $1 billion in share repurchases. So they've used nearly 2 times more free cash flow just on dividends and share repurchases than they've actually generated in free cash flow year to date. So this is a major red flag. When we talk about the sustainability of a dividend, we're not talking about how I feel or what my thoughts are. This is a purely math problem. So how do they pay out more in dividends and buy back shares than they're generating in free cash flow? And the only answer is they're weakening the balance sheet. Almost any time you see a company doing this, where they're using more capital than they're generating, it's going to weaken the balance sheet. And if you take a dive into UPS's balance sheet, I don't think right now it's necessarily in an unhealthy position, but the reality is, due to the unsustainable capital allocation practices, the balance sheet will continue to weaken unless something changes. So really the key question is, 1, will UPS do something about the dividend? Will they reduce it so their capital allocation becomes more balanced? Or number 2, do they have any growth drivers to actually increase free cash flow in the future to where everything else becomes sustainable once again? So let's look and see if we can find the problem for UPS. Why is free cash flow not covering the dividend? Well, to start, here's what we can see. Revenue growth has stagnated. The 5-year is about 4.2%, the 10-year is at 4.5%, but if we really zoom in and take a closer look, it's even worse than that. 2022 is when revenue peaked, and from 2014 to 2022, revenue growth actually looked somewhat attractive, not necessarily fast growing, but it was growing on an annual basis. But again, we've seen a pullback in the last couple of years. Now, when you combine the fact that revenue has actually declined in the last couple of years with the fact that margins have also eroded in the last few years, that's not a good combination. That's what leads to earnings per share and free cash flow dropping dramatically. And that's exactly what has happened. The 10-year average gross profit ratio is about 20.5. The same is true with the 5-year, but last year's came in at 18.77. Not a good combination when you have declining margins and declining revenue. Now, here's the problem with declining revenue. This is simply due to volume declines. We can see third quarter average daily volume declined by 12.3% year over year. 12.3% year over year. That's a major volume decrease. Now, there's multiple ways that companies can still actually grow free cash flow even in the midst of volume declines. And Altria, stock ticker MO, another high yielder, would be a good example of this. That's a company with immense pricing power. And because of that, every single year, they can continue to increase their prices. And so even if volume is stagnating, then revenue can still grow and free cash flow can still grow. But UPS does not enjoy that same level of pricing power. So instead, what has UPS elected to do? Well, UPS realized the situation and announced they're going to cut 48,000 jobs in the year to date as its turnaround play continues. Obviously, this is painful for a lot of employees, but if we look at it through the lens of UPS, it was probably needed. Now, the reality is this is not a long-term fix. This is strictly a band-aid for UPS in the short term. It's going to help mitigate some of these margin erosion problems that we've seen in the last couple of years. The reality is the turnaround play is going to be dependent on whether or not they can start generating positive free cash flow growth again. Now, for reference, if we look at analyst estimates, let's jump over to the sensitivity analysis and look at UPS. And one of my favorite features of ticker data is if we come down here, you can see with ticker data, you can automatically import into your spreadsheet the average analyst EPS estimate over the next few years. This is a really powerful feature. So we can see the projected EPS CAGR according to analysts from 2025 to 2029 is about 10.4%. So that's actually pretty attractive earnings growth. Now again, if we look at the next couple of years though, the earnings growth projections are quite low. They're in the low single digits, so really they're counting on the turnaround play starting in around 2027, 2028, and 2029. Now, if I'm to give my personal opinion, I think these earnings growth projections might be a bit on the optimistic side. And even with that being said, it's still clear in the short term, expectations aren't that earnings are really going to start growing at a healthy rate soon. So with that being said, I do think it's realistic to say that this dividend could potentially be at risk. Now, that's not a popular thing to say about stocks that have historically grown dividends for a long time. For example, if we look at the dividend history on Seeking Alpha, it says they have about 16 years of consecutive dividend increases. Now, I've been in this position before. In fact, I wrote an article for Seeking Alpha back in February of 2024, and the title was 3M, a dividend cut is needed and could be imminent. And at this time, 3M was a dividend king stock with over 50 consecutive years of dividend increases. And I got a lot of pushback from people on this article. They didn't understand how a stock that had grown dividends for over 50 consecutive years could be at risk of a dividend cut. So I got a lot of negative comments about this article. But again, this wasn't a matter of opinion, it was a matter of looking at the company's capital allocation. And I'm seeing the same red flags with UPS now that I saw with 3M back then. And of course, 3M did eventually end up cutting their dividend. So obviously, if you're someone looking for yield, buying into a stock that has a risky dividend is certainly not ideal. I do think there's more sustainable high yield opportunities out there. In fact, I know that. But with that being said, UPS could still be an interesting position. For example, 3M stock actually climbed quite a bit after their dividend cut because it freed up capital to allow them to continue to grow and to fix their balance sheet. So could UPS actually be attractive at about $94.66? And for reference, if we look at the average analyst price target, it's about $103.40, giving them about 9% upside from current prices. Now, analysts are relatively split. We have 9 buy ratings, 8 holds, and 3 sells. So let's look at a few different valuations for UPS stock. Now, to start, if we jump over to our valuation sheet, let's plug in UPS stock. Now, because when we're looking at UPS, we're talking about a turnaround play. It makes the future cash flows, future earnings, a little more choppy, a little more hard to predict. So what do we need to do? Well, oftentimes in these scenarios, we want to look at these stocks through the lens of reverse valuations, like a reverse discounted cash flow analysis or a reverse dividend discount model. So let's start with our dividend discount model. If we go ahead and zoom in. Now, typically what you do with a dividend discount model is you value the stock based on how much it's paying out in dividends and how much that dividend will grow in the future. Well, what we're doing is the opposite in this case. We're trying to back into how much dividend growth the market is pricing into this stock. So for example, at 0% dividend growth, we could see the stock is worth about $77.18 per share, but it's currently trading at $94.70. So what does that tell us? Well, it means the market is still pricing in dividend growth. But just how much? Well, if we bump this up to 1%, we get to $88. If we bump it up to 2%, $102, close to $103. So really the sweet spot is somewhere in between. It looks like about 1.5, maybe even 1.4%. Essentially puts us at the current price for this stock. So the market is currently pricing in 1.4% dividend growth. Now, what does that mean? Well, it means if the stock does end up cutting its dividend, it's very likely that this stock could go quite a bit lower. Basically, the dividend cut is not priced into the stock yet, even though we've already seen a sell-off of about 28% in the last year. Now, if we look at this company through the lens of a reverse discounted cash flow analysis, the goal is very similar. How much free cash flow growth is priced into this stock? So again, we can see at 0%, the stock is worth about $76.61 per share. So how much free cash flow growth is priced in? At 2%, we get to 91.5, and at about 2.5%, maybe even 2.4, we get very close to the current price. So even though over the long term, some analysts are expecting the turnaround play to take effect and earnings growth, free cash flow growth to pick up closer to the double digits, the reality is the market as a whole does not necessarily expect that to be the case. And I'd say that I fall into that boat. That's not to say the turnaround play can't happen and UPS can't maintain their dividend and actually start to see share price growth as earnings and free cash flow grow again, but we have to look at everything through the lens of a risk-reward scenario. When I see a stock like UPS that's battling bad capital allocation, battling margin declines, volume declines, oftentimes the risk is not worth the reward, especially when I know there's much better higher yielding opportunities out there. If you're interested in more high yield opportunities, I cover quite a bit of them over on Dividendology.com. There's a link in the description. So go ahead and let me know what you think of UPS stock in the comments. And again, if you want to get access to any of these spreadsheets in the Ticker Data add-on and get access to the Black Friday sale where you can get 30% off the annual plans as well as a 7-day free trial, then be sure to go to tickerdata.com at the link in the description and use code BLACK at checkout. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.